Over the next 3 slides, let's look at the standard auditor's report from the AICPA for non-public, non-issuer companies. Note that it starts with a title, Independent Auditor's Report. It is addressed to the person who hired the auditor. Normally in a corporation, the auditor is retained by the audit committee of the board of directors. The standard report consists of 4 content sections, paragraphs. The first section is the introduction and states that we have audited the company, what we have audited. We have audited the accompanying consolidated balance sheet of ABC Company and its subsidiaries as of December 31st, 2001 and 2000, and the related consolidated statements of income, retained earnings, and cash flows for the years then ended. The second section describes management's responsibility. We want to make it very clear that management is responsible for preparing the financial statements in accordance with GAAP. It says explicitly, management is responsible for the preparation and fair presentation of these consolidated financial statements in accordance with accounting principles generally accepted in the United States of America. This includes the design, implementation, and maintenance of internal control relevant to the preparation and fair presentation of consolidated financial statements that are free from material misstatement. And also says very clearly whether due to error or fraud. The third section, which is actually 3 paragraphs, defines the auditor's responsibility. We are very clear here. Our responsibility is to express an opinion on these financial statements based on our audits. We conducted our audits in accordance with the auditing standards generally accepted in the United States of America. Those standards require that we plan and perform the audit to obtain reasonable assurance, not absolute assurance, about whether the consolidated financial statements are free of material misstatement. We want to make it very clear what an audit is. An audit involves performing procedures to obtain audit evidence about the amounts and disclosures in the consolidated financial statements. The procedures selected depend on the auditor's judgment. This is very important. The final decision as to what audit procedures to use is made by the auditor's judgment, including the assessment of the risk of material misstatement of the consolidated financial statements, whether due to error or fraud. In making those risk assessments, the auditor considers internal control relevant to the entity's preparation and fair presentation of the consolidated financial statements in order to design audit procedures that are appropriate in the circumstances, but not for the purpose of expressing an opinion on the effectiveness of the entity's internal control. An audit also includes evaluating the appropriateness of accounting policies used and the reasonableness of significant accounting estimates made by management, as well as evaluating the overall presentation of the consolidated financial statements. Then we go on to say, we believe that the audit evidence we have obtained is sufficient and appropriate. In a future chapter, we will define in detail what constitutes sufficient evidence and appropriate evidence. It must be both to provide a basis for our opinion. The fourth and final paragraph is the auditor's opinion. In our opinion, the consolidated financial statements referred to above present fairly in all material respects the financial position of ABC Company and its subsidiaries as of December 31st, 21 and 20, and the results of their operations and their cash flows for the years then ended in accordance with generally accepted accounting principles accepted in the United States of America. Note that if we say the financial statements are in accordance with generally accepted accounting principles, this is implicit that they are consistent and that all required disclosures have been made. We don't have to say it. It is implicit. The audit report is signed and dated. The auditor should date the report no earlier than the date on which the auditor has obtained sufficient appropriate evidence to support the audit opinion. The unmodified opinion standard report may be issued only when the auditors have obtained sufficient appropriate audit evidence to conclude the financial statements are not misstated and there is no need to alter the report for the three situations below. 1. Unmodified opinion with an emphasis of matter paragraph. The auditor may want to emphasize a matter appropriately presented in the financial statements, such as a change in accounting principles. 2. The unmodified report with a other matter paragraph to emphasize a matter other than those presented or disclosed in the financial statements, such as other information in documents containing audited financial statements. And 3, the unmodified opinion on group financial statements. When 2 or more CPA firms are involved in an audit and the group auditor, this is the firm that does most of the work, does not wish to take responsibility for the work of the other auditors. A lack of consistent application of accounting principles results in an emphasis of matter paragraph, such as discussed in Note 5 to the consolidated financial statements, the company adopted Statement of Financial Accounting Standards Update Number XXX as of December 31st, 2000 X8. Our opinion is not modified with respect to this matter. An emphasis of matter paragraph may also result from a risk or uncertainty. Significant related party transactions, the company is a component of a larger business enterprise, and unusually important significant events are examples. When 2 or more CPA firms are involved in an audit and the group auditor, the firm that does most of the work, does not wish to take responsibility for the work of the component auditors, an audit report with an emphasis of matter paragraph should be issued. Here is an example. We did not audit the financial statements as and for the year ended December 31st, 2000 X of Glendo Inc., which statements reflect total sales constituting 27% of the consolidated sales for 20X. These statements were audited by other auditors whose reports have been furnished to us, and in our opinion, insofar as it relates to data included for Glendo Inc. for 20X, is based solely on the report of the other auditors. Then we use the standard scope paragraph language. We believe that our audits and the reports of other auditors provide a reasonable basis for our opinion. In our opinion, based on other audits, the reports of other auditors. Note that we need to identify quantitatively the percent of the company that was audited by the other auditors. The auditor is not required to perform procedures specifically designed to test going concern assumption, but must evaluate the assumption. Conditions to consider include negative cash flow from operations, defaults on loan agreements, adverse financial ratios, work stoppages, and legal proceedings. If a going concern issue exists and is properly disclosed in the financial statements, the auditor would put an emphasis of matter report in their audit report. It is still an unmodified report, it just has the emphasis of matter paragraph. Here's an example. The accompanying consolidated financial statements have been prepared assuming that the company will continue as a going concern. As discussed in Note 1 to the consolidated financial statements, the company has suffered negative cash flows from operations and has an accumulated deficit, conditions that raise substantial doubt about the company's ability to continue as a going concern. Management's plans in regard to these matters are also described in Note 1. The consolidated financial statements do not include any adjustments that might result from the outcome of this uncertainty. Our opinion is not modified with respect to this matter. Now we discussed the types of reports with modified opinions. A qualified opinion states that the financial statements are presented fairly in conformity with generally accepted accounting principles, except for the effects of some matter. The adverse opinion states that the financial statements are not presented fairly in conformity with generally accepted accounting principles. A disclaimer of opinion means that due to a significant scope limitation, the auditors were unable to form an opinion or did not form an opinion on the financial statements. The disclaimer is really not an opinion because you haven't been able to develop one. Let's look at what happens when we have a departure from GAAP. An immaterial departure from GAAP gives us the unmodified opinion. A material departure from GAAP would give us a qualified opinion. And if it's both material and pervasive, we would give the adverse opinion. Misstatements become pervasive when they are not confined to specific accounts, or if confined, they represent a substantial proportion of the financial statements. In relation to disclosures, they are fundamental to the user's understanding of the financial statements. Let's look at the introductory and scope paragraphs when we have a material departure from GAAP that results in a qualified opinion. Here's an example. The company has excluded from property and debt in the accompanying balance sheet certain lease obligations that, in our opinion, should be capitalized in order to conform with generally accepted accounting principles. If these lease obligations were capitalized, property would be increased by X dollars, long-term debt by X dollars, and retained earnings by X dollars as of December 31st, 20x, and net income and earnings per share would be increased or decreased by X dollars and X dollar respectively for the year then ended. Now let's look at the opinion. In our opinion, except for the effects of not capitalizing lease obligations as discussed in the basis for qualified opinion paragraph, the financial statements referred to above present fairly in all material respects the financial position of XYZ Company as of December 31st, 20X, and the results of operations in cash flows for the year then ended in conformity with the accounting principles generally accepted in the United States of America. Let's cover the adverse opinion. 1. Financial statements do not present fairly the financial position, results of operations, and cash flows of the client in conformity with GAAP. 2. We have material and pervasive departures from GAAP. And 3, the auditor believes the departure causes the financial statements taken as a whole to be misleading. Here's an example. In our opinion, because of the effects of the matters discussed in the basis for adverse opinion paragraph, the financial statements referred to above do not present fairly in conformity with accounting principles generally accepted in the United States of America. The financial position of XYZ Company as of December 31st, 20X, or the results of its operations or its cash flows for the year then ended. Scope limitations may be imposed by circumstances, important accounting records destroyed, due to the nature of the audit, like the auditor is engaged too late in the year to observe the client's beginning inventory. They may be imposed by the client, or the client just refuses to allow auditors to do certain audit testing, such as sending confirmations to customers. If a scope limitation exists, the auditor needs to make a decision whether a qualified opinion is necessary or whether the possible effects on the financial statements are so pervasive as to require a disclaimer of opinion. Now we're going to talk about the disclaimer of opinion. This is when the auditor has no opinion. It is issued whenever the auditor is unable to form an opinion as to the fairness of the financial statements. Multiple uncertainties may also lead to a disclaimer. It is not an alternative to an adverse opinion. Here's an example, the Auditors Responsibility paragraph. Our responsibility is to express an opinion on these financial statements based on conducting the audit in accordance with auditing standards generally accepted in the United States of America. Because of the matter described in the basis for disclaimer of opinion paragraph, however, we were not able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. In the basis for disclaimer of opinion, we say, we were unable to obtain audited financial statements supporting the company's investment in a foreign affiliate stated at $20,500,000, or its equity in earnings of that affiliate of $6,250,450, which is included in net income as described in Note 8 to the financial statements. Nor were we able to satisfy ourselves as to the carrying value of the investment in the foreign affiliate or the equity in earnings by other audit procedures. Here's our disclaimer of opinion. Because of the significance of the matter described in the basis for disclaimer of opinion paragraph, we have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on these financial statements. Here is a summary of where to place additional paragraphs in the audit report. Before the opinion paragraph, we put the basis for our modification, be it qualified, adverse, or disclaimer. Following the opinion paragraph, we put the emphasis of matter and other matter paragraphs. Sometimes we may have an audit report that is qualified by 2 or more report modifications. For example, we could have an audit report that is qualified because of both a scope limitation and a separate departure from GAAP. The wording of the report would include appropriate qualifying language in explanatory paragraphs for both types of qualifications. The auditor should consider the cumulative effects of both qualifications. It is acceptable to express an unqualified opinion on one statement while expressing a qualified or adverse on the others. For example, we may have a situation wherein the auditors are retained after the client has taken its beginning inventory. A disclaimer may be issued on the income statement. The auditor doesn't know if income is reasonably stated, but an unqualified opinion may be issued on the year-end balance sheet. The audit report should cover the current year as well as prior period audited by their firm. The auditor can express different opinions on different years. The auditor should update their report for all prior periods presented for comparison. What if the prior period was audited by another predecessor CPA firm? The current year opinion only covers the years the CPA firm audited. For financial statements audited by predecessor auditors, either the predecessor auditor reissues their report with the original date, or the current auditors refer to the report of the other auditors.